Welcome to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management. And today on the show, we're going to continue on from our last show as part 2 of how 10 types of retirement assets are taxed. Now, if you missed our show a few days ago, we talked about the first 5, and they were how IRAs and 401ks are taxed, how Roth IRAs and Roth 401ks are taxed. We also talked about how pensions were taxed, how Social Security benefits are taxed, and then we also talked about how life insurance proceeds were taxed. So make sure to go back to that video if you haven't already. We'll put it up here on the screen as well. And today we're going to be talking about, again, part 2. And part 2, we're going to be talking about some 5 other very important assets and types of accounts that likely you either have now or will have in retirement. But before we get started, make sure to smash the subscribe button and click the notification bell so you never miss a single episode. All right, let's get into it. Okay, starting out part 2, we're gonna talk about annuities. Now, I know out there annuities tend to have a bad rap, and we're gonna be talking about that later on this one. And look, I wanna say this unequivocally here as an advisor for nearly 20 years. Annuities, they have a right play for the right client in the right situation. They're not the end all be all like many people sell them to be, but they are important to understand ultimately if you have one or are looking at one, how they are taxed. If you purchase an annuity that provides income in retirement, the portion of the payment that represents your principal is tax-free. The rest is taxed at ordinary income tax rate, regardless of how long you've owned it. So let me give you a quick example on this one. Hypothetically, if you purchase an annuity for, let's say, $100,000, and now it's worth $160,000, let's say 10 years later, you would only pay tax on the $60,000 of earnings. That's your gain. The insurance company that sold you the annuity is required to tell you this, by the way, and tell you what is taxable. Now, there's different rules that apply if you bought the annuity with pre-tax funds, such as in an IRA or things like that. In that case, 100% of your payment will be taxed as ordinary income. And again, like all of these I'm going to mention today, really important to go through each of these with your CPA and your tax advisor on your specific situation. Okay, next up on our list is how the sale of stocks or bonds and mutual funds are taxed. Now, if you sell stocks, bonds, or mutual funds that you've held for more than a year, something called a capital asset, the proceeds are taxed at long-term capital gains rates. Now, these rates can vary between basically 10, 15, or 20% currently, depending on your income. Now, you want to compare these figures, by the way, to maybe ordinary income taxes. And for many, you'll likely see that these capital gains, hopefully, ideally, are a little bit less than ordinary income, but they also may be equal to ordinary income. So that's something to play into your investing world with your advisor to talk through. Again, something to talk with your CPA about, potential strategies there. Now, the different long-term capital gains rates, they're based on set income thresholds that are essentially adjusted annually for inflation. So you want to make sure you look at that along the way each year. Again, if you sell investments that you've held for a year or less, the gains are short-term and are taxed at ordinary income tax rates, even if they're a quote-unquote capital asset. So further to that point for a second, if you sell at a loss, by the way, the loss can actually offset other capital gains for the year, and you can actually do what's called carry forward. Right now, the law allows us to carry forward $3,000 of income on your losses on a go-forward basis. So excess losses can actually be, again, carried forward indefinitely each year, subject to same tax treatment until those losses are exhausted. So that's the high level of how sales of stocks, bonds, and mutual funds are taxed. We are going to be focusing an episode specifically on capital gains tax, so stay tuned for that. Next up is dividends. Okay, this one's a little bit confusing for people sometimes. Many of us in our portfolio, you'll have dividends, and you likely are thinking, well, how are they taxed? Many retirees, as I mentioned, own stock either directly or through, let's say, a mutual fund or an exchange-traded fund. Dividends paid by companies to their stockholders are treated for tax purposes as what's called qualified. This is the most common, or non-qualified is the other portion of it, okay? Qualified dividends are taxed at long-term capital gains rates. Non-qualified dividends are taxed at ordinary income tax rates. So it's important to know the difference in what dividends you are receiving, whether they're qualified or non-qualified. Again, a great thing to go through with your CPA and tax preparer. Okay, next up on our list is how interest-bearing accounts are taxed. So ordinary income tax rates apply to interest payments on things like CDs, savings accounts, money market accounts, and things like corporate bonds or municipality bonds. Interesting to note here, municipal bond interest, though, is exempt from federal taxes. Likewise, interest from bonds issued, let's say in an investor's home state, they're typically exempt from state income taxes. So you'll likely hear this term before, tax-exempt securities or tax-exempt investments. You may want to own those in after-tax accounts because that's where you'll get the benefit for them. But again, you want to check with your own state's laws and your CPA or tax preparer about this. Again, capital gains rates apply when you sell corporate or muni bonds. So that's important to understand how all those play into interest-bearing accounts and then again, how they are taxed. And final, for part 2 of how different types of assets in retirement or just assets in general are taxed, this one is your house. So your home sales are taxed, yes. But a home is often, for many of us, if you think about it, the biggest, probably most valuable asset that we own, okay? Luckily, the tax law gives us very generous federal income tax rate benefits when you sell your primary home at a gain. So if you owned and used the property as your personal residence for at least 2 out of the last 5 years before the sale, you can exclude up to $250,000 of the gain from income. By the way, that's $250,000 per person. So if you're married, that's up to $500,000 that can be excluded. Any gains in excess of $250,000 or again, $500,000 if you're married are taxed at long-term capital gains rates. That, my friend, is part 2 and compiles the list of what I wanted to put together here is the 10 main types of accounts I really wanted to focus on here on the Make Your Money Matter show because in nearly 2 decades as an advisor, these are the main 10 types of accounts that our clients tend to own or have. I hope you enjoyed this 2-part series. If you did, make sure to subscribe to our show so you don't miss a single episode. And always remember to make your money matter.